Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, March 3rd, 2025. It's 11:40 a.m. Eastern Time, so I'm starting the video. Just going to share my thoughts on the market, reiterate key levels to watch, and on that note, keep in mind that that's what I do here. I provide analysis, trade ideas, and most importantly, obviously what I see, and then key levels that are likely to, trigger buy or sell signals, or produce objective long or short entries. And then the important thing here is I'm just digressing a little bit. I was talking to my brother-in-law over the weekend. He's poor guy, works for the Department of Education. He's got a good job there, and he's going through the Doge thing, and it's not fun. But we were talking about, the markets and everything, and I told him something I've said here many times on the site is, the market's not an ATM in which you can extract money on a daily basis. I've said this many times. The bulk of my profits come on periods. I'll sit back, and I always say, you've heard me say often, wait for your pitch. And then my trading style is depending on what I'm trading. Again, I always try to keep a diversified portfolio at all times. Sometimes I will overweight, and at times I'll go in very aggressively on a certain position. That's just me. If you do this long enough, you have a high degree of confidence, you can do that. But again, at just about any point in time, I like to have uncorrelated assets, stocks, bonds, stocks in different sectors, long and short stocks in different sectors at any given time, depending on what's there, different commodities, not just energy commodities, but agricultural commodities. If they're, time to engage them. There are times that I don't have any commodities if I don't see anything worth trading. In other words, don't force a trade, but be ready for the big moves. And I still maintain, I believe, that if and when this level's taken out, and then again, the 200 days just below it, there's a good chance we're going to go on, and it'll be the start of a much bigger drop down to those longer term swing targets I have on the weekly chart. However, if things go the other way, the levels to watch, I think I gave it to you Friday. These are the resistance levels when I zoom down to the 60-minute chart. And you can absolutely not rule out that we go break to the upside. I've maintained all along I don't think that's going to be the outcome. In other words, I'm talking about the final and ultimate resolution of this trading range. And whichever way we break, other than a brief whipsaw, and again, I say, recognize that. If we break down and it looks like, everything's cratering and you shoot back up into it, this wasn't a breakdown, it was an intraday spike right there. So far, another successful defense at the bottom of the range. Likewise, if we break up, you have my thoughts. If it were to happen anytime soon, we're still going to have a lot of negative divergence, overbought conditions, and other things that wouldn't have me personally chasing that rally on the long side, more so waiting for it to fail. Just like back here when we took out that green line, I told you that I suspected it would fail, and then if it did, and when, that's your next objective short entry. That was right there under the green line, and boom, if you did that, took us right down here to where, again, I covered that Friday. We were very oversold near term, and it's a level I think will go. And so that is my mindset. If that's your outlook, then you want at this point, you can short rallies back to resistance. I gave you levels the other day on Friday where to do that. So let's move on. Anywho, we have bounced back. We're still at that 510.43, which is the first well-defined resistance level. One thing I like to do on different boards, I'll do it here. I had Fibonacci retracement levels, and counter trend bounce is typically going to run anywhere from sometimes you'll stop shy of the 32.8, but the 32.8, which is right here, is a minimum. In a counter trend rally, I typically see them run from about 38.2 up to the 61%. 61.8% fib. 50 is right there, and look how all these levels, actually, the 61.8, I don't know if you can see the dotted lines, but they come in at least the 50 and the 61.8 right with resistance levels that I already have. And this is the what we did basically, the bounce off Friday's lows. It was about a 30, about 38.2. Again, a minimum counter trend bounce. So look, we can remain in this trading range. Anything's possible. We could be in here for a couple more months. I don't think so. I think it'll break sooner than later. But the most important thing when it does, that is a breakdown until unless it fails. And so that's it. So like I said, Friday, a break of Friday's lows pretty much should usher in the next wave of selling. Until then, we may grind around a little bit. That's all I can tell. I can just give you the levels and let you decide if you want to add back short exposure on these bounces to the resistance levels I highlighted on Friday, or right here, up to maybe the midpoint of the range. I really wouldn't want to see it go much above the 61.8, although it could. I'm sorry, the 50% retracement, which is right about the middle, obviously makes sense too. This is your whole trading range, and that's right in the middle, the 50% FIB. Okay, that looks a little messy there. Let's move on. The ones, to me, still the most important stock out there from both a psychological and mathematical weighting in the indexes is NVDA. Let me move this over. Somehow my chart got squished a little bit. And it's also still flirting with the 200-day moving averages. So once we clearly take out the recent lows, then we'll also have clearly taken out the 200 days on a daily closing basis. That's good. A weekly closing basis is better. However, if you wait to the end of the week, let's just say hypothetically it happened today. Let's say they dumped the market today, or NVIDIA, and it closed down below there today. Well, it's possible by the end of the week this stock could be way down there. So there's no easy way. What I like to do is average in, just like I'll scale out of a position when the charts start to convince me I might have been wrong, or start to indicate I might have been wrong. I'll usually, if it's a swing position, and I micromanage. I told you on Friday, covered the lows, took like a little, expected a bounce Friday, and came in today mildly short and took advantage of this morning's pop into resistance to add to those, but nothing crazy yet. And when we break the recent lows, especially in QQQ, and then take out this level NVIDIA, that'll be time to add 2 additional shorts. And then again, NVIDIA, if you look at this chart, I think I covered this Friday, could rally all the way up here. There's a nice downtrend line. There's the deep seek gap. That's where our last short trade was, right there on the backfill of that. Then you broke this trend line. So that's the max level. In other words, here's a trading plan for NVIDIA. I would short up to, in other words, scale in, add to, or a single short if we get to that trend line. Probably not above it. A breakout of the trend line is going to run, and then I'd be concerned any move above, just like when we shorted the deep seek gap, I said you could put a relatively tight stop above it. Same thing. That's where this is kind of a stop out zone. You can do a hard stop or a staggered, a few stops here, whatever like that, because then you're probably going to go see new highs if that happens. Again, that's not my preferred scenario, but always got to have plan A, plan B, and C, and stay flexible and nimble. And if we break down here, then that's your really next objective level when we take out 113.44. But ideally, if and only if, or I should say, ideally if QQQ and SPY have also broken below Friday's lows. So me, I like to look at not just the indexes. I look at the market leaders. Apple, I want to see this trend line taken out on a daily closing basis, not some intraday whip. I want to see Microsoft's already this one's kind of cooked. But, it still has this previous several reaction lows. Again, all these I covered on Friday. Let me move on and cover some other things here that I wanted to show you. Let's do that, because this is just, otherwise we're right about where we were Friday, so it's going to be a repeat of what I covered. But there are some other things I can show you here. Okay, on the comment under the last post I saw Friday, there were a few comments. No direct questions to me, just a couple comments. One was about sentiment. I'm going to loop back to that. Let's talk about sentiment. I've shared my thoughts many times. Sentiment indicators, there's various out there. AAII bull bear spread, that's a weekly survey of the participants that are in the American Association of Individual Investors. Your bullish bearish goes out every week. And like all sentiment indicators, it's contrarian. If you hit this extreme bullishness, everybody's bullish. Everybody's already in. There's nobody left to buy. That's kind of the working model on it. And therefore, that's a contrarian signal that things may soon drop. Likewise, on extreme lows, everybody's, bearish. If everybody's bullish, then you want to maybe start considering getting bearish or not so bullish at that time at least. And likewise, when everybody gets bearish, that's when you want to buy. So you can see here, and this is again the spread. So when you take the differential between those that are bullish and those that are bearish, it shows you the spread in percentage terms. I've said this many times in the past, but it bears repeating. Sentiment indicators are absolutely, in my opinion, absolutely useless unless they're at extremes. So don't try to extrapolate much from them, much predictive value, unless you hit these extremes. So you can see this was the end of the bear market in March of 2009. You hit an extreme bearishness. There was the last bear market we had, that drop right there. You can see we had a couple, and it's not, I always say it's not a buy signal, it's not or a timing indicator or buy signal. Although when you hit these pretty deep extremes, that's often when you get a flush out. Now, obviously we spiked down pretty bad on pretty good there last week, but we're a little bit above where those other ones stopped. And more so, and I've covered this back at the time, and this is where I wanted to address this change in sentiment because somebody had mentioned that before. So what happens is when you have these hills, these extreme periods of bullishness like this, or bearishness, you can see these kind of what I call hills, the damage is already done. It's like that analogy I use of a a hunter making a shot, but it's not a direct kill shot, misses the heart, deer runs off, leaves a blood trail, and they got to go find it. But the damage has already been inflicted. It just may take a little while for that to set in. Same kind of things how I look at these. So, and I've pointed that out before. So it's actually after you've had an extreme period of bullishness or bearishness down below. Once you cross, that's usually, at least in the bear side, and again I pointed that out several times in the last few months here. So here was the extreme period of bullishness, and right when you cross, when everyone started getting bearish, and I say that because there were a couple here on the site back then when we started crossing down bearish, everyone said, oh no, market's not going to drop because now everybody's bearish. No, that's coming off a period of extreme bullishness. And it's actually when they finally flip, as I showed you, that's when, as you follow these lines down, when you flip after the big hills, the extended periods of bullishness, that's usually, like right here, when around when the market tops. So I made that case back here, and so far that is the top in the market. We'll see if it is. So yes, we've had a surge, especially after Friday, in bearishness. The $1,000,000 question, is that just the start of another period of extended and persistent bearishness or not? Again, to me, it's mostly about the technical. If we break those lows and the 200-day moving averages, especially on a weekly closing basis, I believe so. I believe that will be the case. But again, just right now, you can't bet it too hard because we're still above support. And as I often say, I say the same things over and over. Support is support unless broken. So watch those lows from Friday. All right, let's look at a couple more and we'll move on. I'm just rifling through some of my sentiment indicators. This is a CPC. That's the total put to call ratio. And you can see that this is some years ago I came up. I tried this. I played around with moving averages. So I put a 100-period moving average on the weekly CPC. And it just, the line's kind of arbitrary, but it's where I've eyeballed it, where I could go back farther in time. So by using a 100-day moving average, it kind of shows a lot like the trends. It shows periods of persistent bullishness and then more of the trend. Now I have other, put to call where I have hard lines where you hit and that's time to buy, or you hit and that's time to sell, or actually the other way around. Time to sell is when you're very bullish. Time to buy is when they are very bearish. Not you. You got to get in the mindset of being bullish when everyone else is bearish, but only again at times of extreme, not just for the sake of it, because it's bullish or bearish readings can stay that way persistently for quite a while. But either way, what I showed you here, or what I've noted is, we hit this level with the 100-day coming down, and it just shows an abatement or falling bullishness after extreme bullishness. And you come down, and then shortly after, it's again not an exact timing indicator. There is usually a lag, as I'm showing you here, when you kiss that blue line. But these are all the major corrections. And since this bull market, the Super Bull, which I call really, if you look at the Super Bull market off the 2009 lows, if you don't want to call that a bear market, you want to call it a correction, which you could if you look at it this way. Anywho, and so you can see we're getting close. We haven't gotten there yet on this one. And that's just one of many. I take these again collectively. This is the CPCE. I actually like this one better. This is the equity only put to call ratio. So it strips out the index puts and calls. Indexes, puts and calls on indexes are often used by both individuals and especially institutions for hedging. In other words, you want to put together a short portfolio of NVDA and Microsoft, let's say lately, or Tesla, things. But then you want to buy, then turn around and buy puts. Go long on the index. It's a way to kind of gain alpha there, a proxy trade on the index where you're shorting some of the top holdings, but then you're going long or taking the other side of it. So this strips it out. Bottom line is this is kind of shows, all the put call and buying on stocks, individual stocks. So and there it is. You can see I have a red line here. I've had this here for a long time. And this is also the 100-day moving average on the CPC, just like we were looking at on the CPC a second ago. And boom, when you hit that line right there, you had a 22% drop in the S&P. Remember, the NASDAQ falls more. I have the S&P under to kind of show you, we hit it there, 58% bear market back in 2007 to 09. 22% drop in the NASDAQ, or in the S&P, 16.3, but more so we went sideways for a year and a half after that tag right there. And then you can see we stayed persistently bullish for a while. The 100-day moving average crossed down there. There was a lag. It was a lag of, that was a good year or so before the top was in. And now I want to point out, there it is. We just hit it. So maybe there'll be a lag. Maybe not. Sometimes the top comes pretty quick right after that level's hit, and sometimes it can take a while. Again, these are just conditions. So I'm trying to show you, some people get hung up on the readings that week. Oh, there's a big change and there's a lot more bears right now, so the market's probably going to put a floor in. I see things a little different. I will recognize those spikes. You can also see down below, I have a line. I have two lines. This is an extreme. Down there it's about 39% or so. That's 0.39. And this is right at about 0.425, give or take, about 42, so about 0.42, the ratio put to call, meaning extreme bearishness. Everyone's loading up on puts instead of calls. And I'm sorry, the other way around. They're loading up on calls, put to call ratio. And this is where everybody's getting bearish. So I want to point out the last time, here's a couple times we hit it. Remember, this was the end of the worst bear market, one of the worst in history. So you kind of get a reset there. And then, it took a couple years into the new bull, you got the extreme bearishness. So in other words, after a 58% drop in the market, you don't look for the first tag to load up on shorts. But then 2 years into it, you can. So you hit a tag of that extreme level there in 2011. A couple months later, the top was in a 22% drop. And then right here, we had, again, this was COVID. The world stopped turning for a while. Global government shut down. 36% drop in the S&P 500 in just 6 weeks. So that was certainly a bear market, one of the shortest in history will go down as. But and so you had the extreme bearishness, but then then you reset. After about 2 years later, that's the first and last time you hit it, right before the top. Remember, the NASDAQ 100 peaked in late 2021. Almost put in a new high just like recently, but failed to, where the S&P made a marginal new high right around on the first of the year in 2022. And again, that followed that reading. So as I said, we have not fallen to that line, that line there, until recently. We hit it, and now we've almost double tapped it. We hit it. Recently we came down close to it again. So that's it. So I just wanted to point out that. And that. So we're there, guys. We have enough right now. Could it get more? Yes. Like I always say, oversold is not a buy signal, because oversold can become more oversold on a security, on the index, or it can stay oversold for an extended period of time. But they are conditions. Conditions, when things are oversold, you might not want to start shorting aggressively if you haven't shorted that security. Likewise, when things are overbought, not a sell signal. Try to short NVIDIA every time it hits 70 or 80 on the RSI in the last few years, you would have been smoked. Again, overbought as a condition, but you may not want to chase it. That's how I kind of view it, especially for an investor. Traders, you know me, I'll zoom down to the 5, 15-minute charts, 60-minute charts. That hones down my entries and exits. I'll look at the dailies, obviously, and use those too. But again, as an investor, when something's extremely overbought, and again, look at the extremes on it, look at the RSI and other things, that's a condition that, even though it can persist for quite some time, usually will be followed by a nice correction. So ideally, you want to be buying stocks when they're oversold and selling and or shorting when they're overbought. However, other things need to come in. You need to have support level breaks or pullbacks, or bullish breakouts, bearish breakdowns, that kind of stuff. All right, let me go a few more. Sentiment, I'm just kind of clicking along here to the ones I like. This is a CPC, again, the put to call ratio, the one we started out, total put to call ratio. And you can see I have green. That green kind of moved. I need to drop it down a little. What hasn't moved, I've always had this line here. This is my, you can see excessive fear, wait for buy signals to go long and cover short. So that's the key right there. Wait for buy signals to go long and cover short. So in a bear market, you hit this, it's a heads up. What it tells you is everybody's loading the boats on puts. A lot more people are buying puts than calls. And when you get there, that's usually when you want to start buying stocks. You got it right there at the end of COVID. It was one and done, quick little tag. There was the big Q4 drop of 2018. If you were trading at the time, we nailed that one on the way down short, reversed it long, had a great trade on treasuries. But it was one of the biggest drops in years, and that's when we hit it there. So you can see these points. I'm putting the lines here. This is where once we've determined that a new bear market's underway, and we're not there yet, guys. We need to break, like I said, let's get under the 200 days. We'll start talking about this. Then I'll be looking at that. Last time we hit the green level was right here. That was right there, and big correction. That was the great buying opportunity right there. So we haven't had this. There hasn't been this excessive fear, especially on this indicator. Look at that. This is all we've got recently. But what we have had down here is my red zone. This is extreme complacency. This is where everyone's bullish. You wait for sell signals to sell your longs and or go short. So boom, we had a tap. Again, it was the first time since right here, right before that 27% drop in the S&P, which was a 38% drop in the NASDAQ 100, this whole box here. And again, we hit that there. We had a shot across the bow, went up, made a new high, marginal new high, and that's it. So these are, kind of things I watch. That's CPC, just another board. Let me see if there's anything else I want to show you here. A lot of these are the same ones over and over. Yeah, that's about it. All right, let me look at a couple other things. Here's that SMCI. I mean, just what a beautiful trade. We shorted it there on the rally into that downtrend line, then exited there based on or a little above there on the 60-minute chart. Hit that was targets I gave you, T2. Where was T2? It was only T1, and then re-highlighted right here in a video the other day, last week, as another short entry. 31% again on top of the 30-something we made on that first drop there. Wow, it's just this thing. So what I'm getting, a lot of these overhyped, bloated stocks, they're exhibiting bear market action. This is what, this thing peaked back here, and it was, again, it's not the poster child. NVIDIA's a poster child of the AI bubble, but this one was right up there behind them. And also, it's trading very correlated to it. I wanted to just tweak that trend line. I don't know why this one moved. I just noticed it should come in, the trend line off the high. It should come in with the all-time high there, that reaction high. You have another one right there, and then this one recently. So, look, if 6 weeks or 6 days from now this thing pops that downtrend line, it's going to have regained the 200s. That's nothing but bullish right there, and you're probably going up to at least there. Who knows? Maybe new highs. And then I'll look. Now, when I gave you this one the other day, right here when we reshorted there, I gave you 1, 2, 3, 4 targets, and we were at the top of that first target zone, which we also hit on Friday. So, but look at the bounce. A lot of these bounces are getting sold into today, so it's kind of confirming what I suspected. Either way, still like that one. Bitcoin, I already gave you an update there. There's nothing to say about that. Bitcoin's just been a beautiful trade. Especially if you took the bounce, because the markets were supporting everything on Friday. Yeah, I know there was some news, Trump something over the week. If you're trading off news headlines, you're driving in the rearview mirror, looking in the rearview mirror, because when would you have bought it? Today? You would have bought that pop up. The pop happened overnight, so Friday was the time to go long. It came that bounce right up. I get that little yellow area right there. I told you that's the reshorting zone, or so hit the top, and that was at the top of the gap. Boom. So, anywho, now the way this works is so far so good, but for longer term, now we need to break again. It's Friday's lows. We break Friday's lows, we're going to have taken out T2, which is price support plus the uptrend line, and that should open the door to these next targets. And again, on BRR Bitcoin futures, I gave you the longer term targets on that daily chart I've been posting at the arrow breaks, of course. And there's MBT. For those of you, the BRR is a big contract. It's BRR. Every single contract constitutes $454,000 of Bitcoin. That might be a little rich for most people's blood. MBT is the micro Bitcoin contract. I think it's like 1/10 or whatever. So if you are a futures trader, you can use MBT instead of BRR if you want to trade futures for the obvious benefits there. Otherwise, these ETFs are your thing. And there are, by the way, inverse short ETFs. There's so many out there. You can just Google search short Bitcoin ETF. Probably don't want to use a leveraged one. You don't need leverage. Bitcoin's juice. It's like the VIX. I always say, I like VIX futures, but those of you that trade VIX ETNs, I give you VIXY as a trade idea because it's non-leveraged. You don't need leverage. The analogy I use is like going buying a $800,000 Ferrari and then taking it down the street to your mechanic and telling him to put nitrous oxide on it. It's overkill. You don't need it. VIX moves up enough as it is, and so far so good. I mean, this is the downtrend line here. Like I said, if we're going to pop this level, we need to pop. And I'm actually surprised we tested the bottom of the trading range, and the VIX has been relatively muted. So I'm just going to say this. I think if I'm right, and we are going to go on breakdown, VIX is still cheap. I told you it was cheap back here when I laid out this trade idea. I give you some. This is VIXY. Let me look at the spot VIX for a second here. But again, now, if we're going to go to new highs, or we're going to break above the trading range, the VIX is going to go down. So yeah, the spot VIX, which is more important of the two. Remember, VIXY tracks the short-term VIX futures. This is the spot VIX, and it did run up to about the top of that trading range again, which coincided with Friday's lows, with the market hitting the bottom of its trading range, especially. And remember, it's the NASDAQ 100 has the better defined range than the S&P 500, and the VIX tracks the S&P 500. I trade the VIX, because it has more juice than you need. There is a NASDAQ VIX. It's just not the futures aren't as liquid, and I don't know if there's any ETFs out there that trade it. This is what it looks like. The chart's kind of blah. So, but you can see from the chart, this is the NASDAQ VIX. Look at this line. I've had it here for a while. We had one little brief daily pop, and then that was it. We fell right back below it. So we have boom, boom, boom. That's where we ended Friday, right about at that level again. When QQQ tests my yellow key support level and NQ. So if they go, this is going to do this. If they start the NASDAQ goes up towards the top of the trading range, it's probably going to come back down here. You can see there's my kind of the bottom of the recent range support. And again, I don't know if there's any ETNs or ETFs that track the NASDAQ volatility index or not, because I don't trade it. Quick update on Natty. That's natural gas. This is NG, natural gas futures. Latest update is we finally had a divergent low. You can see this is a chart I've been working off of. I need to tweak this line because we just by the skin of our teeth held that. We came down to nice support. I believe in the last update I highlighted this. We had boom, boom, reaction high, boom, boom. And that's 3,748. Remember, these things keep rolling. So the chart I would have had a month ago would have been the March contracts. These things roll. But we did put in the most recent divergent, aka bullish divergent low here at support, and it went up and popped this downtrend line. Now what you can see, or I think you can see, I'm going to slide it here. I've drawn out here because remember, all along since last year, I've maintained a long-term swing target around just under the 490-ish support. So what I'm favoring is one last final leg up I'll probably scream if it takes out these recent highs, especially boom. You want to see boom, boom, boom. Traders are going to look. There's a downtrend line, which was actually taken out today. Now, if we can take out that previous high, you're going to have traders with stops there that get hit. Take out that high, you're going to have traders start to stop out. Okay, had to pause the video there to take a call. All right, so either way, that I believe is the most likely scenario. There was this trend line violation, but things like that, and you get an uptrend, can be pretty bullish because then it sucks in. Remember, pulled back to there, but that probably blew out some stops. Anyway, that's where I think this thing's going. At this point in time, let me just say, for those of you that happen to still be long, I think a stop under that support level, especially now that we had a nice strong reaction off it, makes sense. Somewhat is you got to give it a little room on natural gas. Keep your stop out of the. If it's too tight, they'll just run it. That's what they do. So that's your update there. And of course, if you're new to the site or you hadn't seen, this is my long-term chart, weekly chart, natural gas, nat gas, continuous contract of futures here, and so this is that divergent low we were long off of as a long-term trade. There've been a lot of in and outs highlighted, pullbacks to support, little divergent highs along the way to give you these corrections. But either way, as I mentioned in the past, these rallies average north of 200% off comparable divergent lows on the weekly. And at last check, this is through Friday's close or last week's high, 162%. So close, but still below the average. Doesn't guarantee we're going to be, and if we happen to, I can see the potential. We're in an inflationary environment that we punch through. There's my target, just shy. It's about 490. So again, we're getting close there, and at that point, we'll have nice, big negative divergence on the 60-minute, even the daily. You can see it start to show through on the weekly, and that would be an exit point, and maybe a pullback if it comes all the way back into the trend line, possibly another thrust up. We'll just have to cross that bridge if and when we get there. And for you ETF traders, remember I gave you UNG as the proxy for it. I said it back then. These are there was long-term support. We were buying it at with the divergent low, and this is where the uptrend kicked off. And then, as I said all along, we had this trading range here with one whipsaw out of it. Other than that, it was well-defined, and that's once we cleared it, that was off to the races. And this is the trend that we have. This is an uptrend. When we hit T8 was the final target there, but I also said at the time when T8 was hit, there's decay in this. It's an ETN, it's rolling futures, and so you're better off tracking, using the long-term targets and watching natural gas, even if you're trading this one. And there's that little trend line violation so we're actually back testing it right there. But again, I think if they punch this high, there'll be a lot of short covering. You'll probably get that one last, probably aggressive punch up to those final targets there. And then you'll just have to watch nat gas futures and sell just shy of 490 if you're targeting that. And the juice broke out of that bullish falling wedge I gave you, not OJ Simpson. We're talking about orange juice futures. OJ is a symbol. As I highlighted, this one went parabolic on the daily chart and the weekly charts. Orange juice price futures went crazy, just like cocoa futures and coffee futures. So I'm still short those two, but long OJ futures, looking to game a bear market rally bounce, minimum target there. Again, I've covered this before in recent weeks. I just want to highlight that it broke out on Friday and it's following through today so far. So it looks good. Just don't fall in love with it. Coming off a parabolic top, it's been beat down big anyways. I don't know how much more downside. Coffee's bouncing today, but still profitable. From where we shorted that. This is cocoa. I just want to highlight because cocoa's at support right here. This is a 6-month, 2-hour chart, and you have some positive divergence. So I actually I'm going to do this right now and decide if I want to just cover this one here, see if we get a bounce out of it, maybe reshort. Let me look at the longer term chart here. What did I have? Did I have a 5-year on this? Yeah, I did. Okay, there's that support too. So yeah, that was one of my targets. Remember, we were at this support before. We broke that target, that 96.80. That opened the door to the next leg down. We already had one bounce off this level, so it could go this time around, being the fact we already had one bounce there. If so, these are your next targets right here and here. And again, it went parabolic. It doesn't show on this chart, longer-term charts. Big divergent high. So I still have a pretty high degree of confidence it's going to come down, probably all the way to this trend line here. It's just trying to play the zigzags. All I can tell you now, we're at support. But again, when I drop back to that shorter term chart, where were we hourly? No, we were 120-minute candles. We already had almost, yeah, actually close to that level bounce there. Now we're actually right on the support here on the 120-minute chart with divergence. I'm just going to wrap it up here with bonds, even though I don't have a position in bonds. I quite often do, but right now I don't have a strong conviction of where they're going. But I just wanted to talk on the price action. This is the 10-year. This is IEF, tracks the 10-year Treasury bond. And if you followed me for a while, last year I gave you these zones back here. When you can see it says green zone, net bullish for the stock market. Yellow zone, the stock market will start to take note of rising yields, because remember, this is the price of bonds. When the price of bonds fall, yields are going up. And so orange zone, stock market really starts to take note. And then the red zone right here, stock market will freak out. We haven't gotten to the red zone yet since I started these boxes. And I have a caveat up here. Any advance due to a strong stock market sell-off will be a flight to safety bid, if you will, and net bearish, not bullish. And that's exactly what happened. Remember, we shorted the top of the recent trading range on QQQ, and we fell back below my green lines, and we plunged straight to the bottom of the range. As expected, it was a pretty swift down. So this whole advance in Treasury bonds, it was an abatement in yields. Yields have dropped. But again, that is 110% a flight to safety bid. So I'm kind of discounting the fact that we're back in the green zone, because I can just look at the charts. I can see when the heavy days, when stocks are selling off hard, those are institutions selling stocks and moving into treasuries as a flight to safety bid. So that's, again, I'm not going to spin it as outright bearish, again, because the yields fall back, and it's that whole vicious cycle I started giving you, 2-3 years ago about that's how we'll trade the market. Stock market will start to rally, and then rates and commodities and everything are going to start to rise, and then that's going to then create inflation worries again, which is going to give you the next correction in the stock market, and so forth and so on. So I just wanted to point that out. That's where we're at. There's also a little uptrend line there, but either way, I just wanted to say that we've punched back into the green zone, but again, based on the fact it was due to that recent pretty impulsive selling. And then I also went on back then to say that the impact on the economy and stock market is a function of both the price level, in other words, are we here in the green, yellow, orange, or red zone, as well as the time below the green zone. So remember, it's not a one-time thing. In other words, if rates were to surge again and we go down here, and treasury bond yields and interest rates in the economy rise again because of that, if it happens quick, it doesn't. It may not even have much of an impact. You may not be buying a new car or a home, getting a mortgage that week. A business can delay refinancing or putting off closing on something for if it's just brief. So the longer we stay and the lower we stay, that does and has had. Now this has already happened. I'm speaking now past tense. We've been spent for over a year now down in my yellow and orange zone. In other words, the other way to look at it, guys, is real easy. TNX, take the 10-year Treasury yield, the rate on the 10-year bond, and this is what we're looking at here. So I'm rolling back. I just went to a weekly chart. This was the super duper nuclear button, free money for everybody, COVID stimulus, monetary fiscal, rates down to the floor. And this has been rate since. So the point is, remember, we had 3 rate cuts. We haven't seen this, I don't know if ever, or at least not in decades, where the Fed cut 3 times in a row, and each and every time they cut, rates went higher. So the Fed's lost control of the long-term yield curve. They kind of backed off because they saw that was a very non-effective strategy. They cut rates, but not a single person listening to my voice gets to borrow at the federal funds rate, the rate that they set. Only banks get that free money or that low rate as overnight lending rate. You and I go to the bank, and we're subject pretty much to what the 10-year is doing, whether it's a car loan, a mortgage, boat loan, business loan. Those are going to track closer to the 10-year, and you can see. So this is my thing here, is that rates stopped rising, but they stayed elevated, and they've been chopping around this range. And as longer that is, more and more companies that refinanced in recent years down here and down here, a lot of them jumped on those they're coming due. Large cap companies, I think it's, what is it, 5 to 8 years. There's about a roughly a 7-8 year, and again, it depends, large cap companies, how far they typically roll out their debt. So you've got these companies, they call it the debt wall, and they're coming due, they're maturing. I just read today a large gum maker went bankrupt, and one of it was couldn't service its debt. Don't get me started on the regional banks, but anyways, that's it. Let's stop it here. This is what I wanted to get out to. You know my thoughts. NVIDIA is still down today. That's that's one of the most important stocks. We're short that one, or shared as a short trade idea, and it's they're not buying it today. They tried to buy the market. Markets are about flat as I talk, but NVIDIA is down, and this has just a big psychological and actual weighting. This is all everyone's, all the, just any 401k, pension funds, hedge funds, because it is index. If you own an S&P 500 index fund, if you own a growth fund, you're top heavy in this. You may not know it. And again, it's been a crowd favorite. And so let's watch that level there. I'm going to wrap the video up here. This has been Randy Finney with Right Side of the Chart. Have a great day.